right, stop share. All right, welcome everyone. This is Eddie, and today is Saturday, and we're here for the Saturdays with Eddie show, right? Saturdays with Eddie. It's not a show, by the way. Yeah, where did that come from? Do I speak Swahili? Of course I do. Yes. That was Sunday's question over there. So topic for today is offense and defense. Most of the time we're playing offense, but we also need to play defense a little bit. And what's the difference between those two? Offense is obviously when you're going long on a particular trade, you have a thesis that the price of the underlying is going to increase, and so you buy a call, or sometimes you have a thesis that the price is going to reduce, so you buy a put. That's offense, right? But there are times when your thesis goes bust, it's not working. And what do you do in such a scenario? You're down, you're underwater, and you have to play defense. You have to recover from that position. Maybe you forgot to put in a stop loss, or you put in a stop loss that was unreasonable, or something happened anyway. You don't have a stop loss, and so your position is not doing so well, and you want to recover from that. So how do we do that? So I'll keep it kind of low level so that you have the opportunity to ask questions. From the faces that I can see here, you all know how to do this. So it's going to be sort of a Q&A, and then I'll sprinkle in some thoughts that that you can share with others or yourself. Does that sound like fun? Sound like fun? Yeah. And by the way, happy Easter for those of you. Yeah, thanks, Pep. Awesome. Happy Easter, by the way, for those giving up your Saturday on an Easter weekend. It would be remiss if I did not say happy weekend. He is, yesterday we celebrated, or we remembered his death. We'll talk about Jesus Christ. And Sunday he is coming. So that's one topic I'm never ashamed to talk about, because I am Christian. And so happy Easter to all of you. Right. Awesome. Cool. So going on the offense, it's just like sports. Why would you even think of it that way when it comes to trading stocks? When you're playing football or rugby or any other kind of game, you want your best foot forward. You want your best team. You want your team to play the best way. So would you wait until the middle of the game to go into the to play? What's the best way? You start at the beginning of the game, right? Why would you wait until the second quarter to go into the Super Bowl? Imagine that. Who does that? Does anybody do that? Right? Nobody does that. So in your trading, let's see whether we can have that analogy. Why would you enter in between a buy zone and a sell zone, or a support and resistance, to start playing the game? Let's put it in simple Eddie speak. That's nuts. Don't do it. Right? Yet we do it all the time. So let's learn how to play well. Let's learn how to play well. So the first thing, when you are going to get into a trade, figure out, has the game started? Right? Has the game started? And if it has started, why do you want to get into the middle of the game? You either wait until the halftime and you wait for the referee to call a substitution or something, but you don't just roll out of bed and get into the game. No, you don't do that. You get in at the beginning of the game, and it's that beginning that we want to talk about. So I'll share. Am I still sharing my screen, by the way? Yeah, maybe not. Let me share it again here. I'm sharing. I thought I was sharing.
No, you're not.
I'm not. Okay. There we go. So everything this week or the last couple of weeks is kind of been at either falling or in some weird place. What's happening to Thinkorswim? Maybe it's because it's Saturday. Funny how we come up with all these excuses, huh? All right, I'm going to try and find a stock that's typical of what's happening. So that's Airbnb, that's American Express, SEDG. This is nice. Okay. All right. Let's go with the Melee. QQQ. NVIDIA. I like that. All right. And one of my favorites, SOXL. So when we're considering whether to enter the trade, we need or enter the game, we need to enter at the beginning of the game, what I call at the right zone, right? If you're going to go long, if you think that the price is going to go up, well, don't wait for it until it's in the middle of somewhere before you go in. Wait for it to come to the bottom, to the support area. You know, when I say support, I'm referring to the buy zone. Anybody confused about that one? Support, resistance, buy zone, sell zone. It should not be even be options 101. This is like stock trading 101. Do we need to go over that? About what support is? Right?
No, but I do have a question.
Yeah, go ahead.
You had mentioned earlier that you don't use chairs to find your zone. So I was interested in knowing, I mean, would you because of that miss out on opportunities, or does that work in your favor? Does that work, against you by not identifying that? What has been your experience, and why did you say you don't use chairs?
Because once you discover options, you realize that there is leverage that you can use with options. So have you traded options at all?
Yes, I've traded a little bit.
Okay, just a little bit. Then we'll talk about it some more. But when you're working with shares, you have a limited, or you have a finite. Maybe it's not even finite. The results are very limited. Let's put it that way. You can get good results, yes, but you have to spend a lot of money to do it. And the reason that people move over to options is so that they can use leverage. One options contract represents 100 shares. That doesn't mean that you will get 100 times profit. It just means that you're going to be able to move more of that money around. You're going to be more control of the results than when you're using shares. And we can do a quick example towards the end of this
No, I'm
session.
sorry. I think you misunderstood
Yeah.
me. I meant to say chair formations.
Oh, chairs. Oh, I'm so sorry. I
I
had
was saying chair formations.
chairs. Okay,
And
like lazy boys and stuff like that.
you don't use chair formations when you're finding your zones. So I was
Yes,
wondering
that is
why not
correct.
do you
Why
miss
don't I do that?
that way? Yeah.
Okay. Pretty easy. They're not zones. They're not worthy of note, in my opinion. You need the true zones are when price changes direction. Okay, when price changes direction, that is when you get a very, very powerful zone. Price was going down. Let me see if I can bring up one of my ink tools here. And look at that. Price going down, price going up. That's a zone, right? Price going up, price going down. That's very, very clear to me. Now, when I start looking for things like, this chair formation over here, that is confusing. What in fact is happening over there? Nothing, in my opinion, right? Nothing is happening. So I don't look for chairs. I don't look for funny formations. I only look for two formations where price changed direction. If it was going down, it starts going up. And if the price was going up, starts going down, that's the peak. So that's what I do. Everything else to me does not constitute a good trade. Remember, I only trade good trades. I don't trade, or I don't enter a trade where I'm just kind of guessing that these are going to react to something, at a chair. No, that's just wishful thinking. So for that reason, I do not do it. Right? They may be valid. I'm not totally discounting them 100%, but I'm only discounting them 99%. But you get my opinion. I don't care for them. So,
Eddie, picking up on that topic,
yeah.
could you expand on gaps as zones as well? I've heard you say that in passing.
About gaps.
a gap as a zone in its own right.
Definitely, definitely. A gap is definitely a zone, and we can demonstrate that so easily. In fact, I'm just going to go to one of your favorite symbols here, which is SPX. Got to go to the 5 days 15, and let's see what's happening. Would you consider these a gap over here? Some of from down here to over here. Is that a gap?
Yes.
Okay, I think it is a gap as well. And this gap has formed a resistance. Okay, what happened when we approached that gap? Did we test it?
Yes, it was tested.
Did we test it again over here?
Yes.
Yep. And what's going to happen once we pass that and we go up? Do you think we're going to test these on the way down?
Yes.
I think so. So we can surmise based on not just this one chart over here, but on numerous charts, that when we have a gap, we immediately form a resistance and a support zone, right? That's your resistance over there. See whether I can bring up my wiggly tool. Resistance, support, right? When the price is above the gap, then the bottom of the gap is the support. When the price is above is below the gap, then the beginning of the gap is resistance. So that's how you play that. It is not a long candle. You can't treat these as one continuous candle. It is very, very, very significant that there are particular reasons why this happened. Either strong seller action or strong buyer action. That's what causes those gaps, and they're super significant. We always try to fill them. This is a gap over here, and you notice how SPX plays. So this is Tuesday. This is what happened on Tuesday morning, right? Tuesday we gapped up and then started coming down. But look and see what happened if you're a gap player, right? The minute you see these red candles start filling this gap, what do? You get into that put, right? You get into that put. In fact, you almost ignore everything else that you had plotted on the daily time frame. Remember, we always plot on the daily time frame. But once you start entering this gap, what does SPX normally do? It starts filling the gap. That's a gap play. Now, whether you continue on, that's up to you. But at least most people, once they play this gap, once that gap is filled, they simply get out. Okay, they simply get out of that, and then it becomes no longer relevant after it has been filled. SPX is very, very gappy. Is that a word?
I use that word in my own mind a lot.
Okay,
yeah.
It's very gappy, right? That's a new word. Let's coin it. Let's make an EFT out of it, or an NFT.
Yeah, an NFT.
And then we're going to make an NFT out of that. That's the next big thing. So yeah, to answer your question, gaps are significant, not just on SPX, but on actually not almost every symbol. So play gaps in that particular way that they do get filled most of the time. There are some stocks that I trade that I know that will always fill the gaps. SPX is one of them. Amazon is another one. Almost always fills the gaps and then turns around and does something else or continues in that direction. Yep. So yeah, Sandra is saying that the V and the U are stronger zones. Anyway, that is true. Very, very true. And by the way, there are as many strategies as there are traders. So don't take my words for the gospel truth and say that this is the only way to trade, right? That wouldn't be wise. If you can find an edge in your trade and find it and make it consistent, go for it. So, this is in reference to the chairs. If you find chairs are working for you, by all means, work with them. So not a big deal. But for my style of trading, I just go with the V's and the upside down V's.
Do you find yourself waiting a long time for those V's and you know what I mean?
Yes.
It may take 2 or 3 weeks or so just for it to.
Exactly. I agree with you in that. In fact, that is one of the the major bones of contention about, when you're waiting for that V formation, you do wait a long time. So to your point is, how do you like losing money, right? You don't. So you need to wait. Patience is part of this game. And especially these last few months, these last few weeks, it has been just a waiting game for everything to come into a zone. What do you do when you come to the zone? That is when you strike hard. But remember, always play, small positions, diversify your watch list so that you always have something coming to the zone if you could.
Right? Hey, Eddie, can I ask you a question about the chart?
Yeah, please.
Where you have drawn that horizontal line up to the top there, that looks like that has been a zone of some sort. Look at all of the consolidation all the way across. There's 1, 2, 3 areas of. Does that tell us anything?
Which price point are you talking about?
Let's look at 44.40 is the upper.
Okay. 44.
A little lower. Let's go a little lower.
Oh, this one right here?
Yes, that's correct.
Got it. Yeah, that line, in fact, you started with a consolidation over here and it formed a zone. Why did it form a zone? Notice that the gap happens after that, after that consolidation, but we keep coming back to that zone. We test it again here. We kind of pause a little bit here. And I bet you that once we start going up on our way up, 44.40 is going to be very, very significant. Okay. I have a term for these. I call it the magnetic zone, right? I call it the magnetic line or something like that, where price seems to just keep coming back to it. And we can interrogate that even a little further by going to let's go back to the daily time frame here and see what 4400 is telling us all about. So 4400 price line, and we're going to mark it here. We're going to make it a little bigger. So look at that, 3 days in a row, almost 4 days actually, we tested that line.
Okay.
Right? Is it coincidence that we're stopping at 4400, give or take? It is not. Or 4440. Thank you for that. 44. Well, 4440 and also 4400. I thought 4440. You said 4440, but I'm thinking 4400 also is a very, very important, or very significant level. We're not just stopping here for just because time ran out. No. So I think this line over here, let me duplicate that and come back here. So 4400 is also very, very significant. And you're right. That's called a magnetic point. Going back 9 months, we seem to test that level quite a bit. It's also something that it is, I've heard the term, what is the term? Psychological number, right? It's like, in the markets. It could be that, where banks just put out a price and stick with it. So there we go.
Thank you.
You're welcome. Sure.
Eddie, can I ask a follow-up question on the SPX gap that you charted earlier? I think you mentioned it occurred last Tuesday.
Okay.
I don't know if this is the same chart we're looking at or a different chart, but since we know we expect the gap, that price will kind of test the support or resistance that's formed as a result of the gap, and then kind of retreat and then test again and perhaps fill the gap subsequently. In that first retest, when we don't actually anticipate that the gap will fill initially, would you recommend to purchase an option in the opposite direction than what you expect the gap to fill? So with the gap that formed before that, we're looking at the formation a few minutes ago, we expect price to fill up, so you'd purchase a call. But in that first testing of the support, would you expect actually prices to bounce back? Would you purchase a put in the first instance and then a call once it starts to fill up again?
I think it might be better if we look at that particular chart you're
Yeah,
referring to.
yeah.
So I'm looking at SPX, and which gap are we referring to?
You were on the 15-minute chart?
I am now on the 15th. Let's go to 5 days, maybe.
Okay.
Okay, there we go.
That gap, yes,
Are
on the
you
left.
talking about this one?
No, the previous one on the left of
Oh,
your
this
chart.
one?
That,
Oh, yeah,
yes,
this will
that
be
one.
filled for sure. Yeah, 100%. I can say that
And
with conviction because it is above the current price, right? Those I can say with conviction, by the way, that yes, we are definitely going to fill those gaps. But the gaps below, I'm not usually so confident unless I'm looking at some zones. But I think your question is, how do you play this gap? Is that your main question?
It's more convoluted than that. Apologies. So in the first instance, right, the green candle to the far right tested that kind of support level. Yes, that one.
Yep.
And then in the subsequent red candle, the doji, price
Mhm.
retreated and actually went back.
Yep.
So can we say that usually in that first testing of the support, that's been formed with the gap, that we don't expect the price to fill initially, the gap to fill initially, and that the price will be tested and then retreat. And so in that initial retreat, would you purchase a put? Because you can see that subsequently kind of price went down quite a bit before it retested again. So would you play it both ways, not just a call in expectation of the gap to fill, but then also put in the initial retreat after the first testing of the price level? Or is that
Got
too
it.
aggressive?
I don't know, but how would I play this? Well, first off, when this is going up, this is actually resistance, right? This the beginning of this gap is resistance. Just to correct, I think you said support.
Okay, you're right. Sorry. Yes.
And then this would be a rejection. I would call this a rejection. When price tests that, in fact, if I break this down into about 5 minutes, I can see what the projection was or what the trend was, and I would know that there's a rejection before I even see this 15-minute candle. First and foremost, I've got a long wick at the top. What does that tell me? There's intense pressure, the intense selling pressure. So this would never be broken. We were not able to break that resistance. And then this kind of confirmed it. This one definitely said, forget it, we're not breaking it. How would I play this gap? It's no longer a gap play because we've missed it, right? We've missed it, or rather, the price, the market has said we're not going to fill this gap. Also, you cannot trade SPX on its own, especially when it comes to filling this gap. You have to figure out what else is going on in the market to determine whether we're going to fill that gap or not, because we don't always feel it on that same day. But for that particular day, you have to know what's going on. So on Tuesday, I don't remember what was going on Tuesday. Is that when we were releasing the CPI numbers and stuff like that?
I believe so, because
Yes,
the
it
next
was.
day was producer
Yeah.
price data. Yeah, so I think Tuesday was CPI.
So you can see that economic event was obviously guiding what the market was thinking about. And once those numbers were, what those numbers were significant is because they were talking about the interest rates plus inflation plus general consumer sentiment. Right now, I think the numbers are telling us that people are hurting. People are not being able to afford stuff. That's what inflation is all about. It is on gaps. Why do we ignore weeks? We don't ignore weeks. That was Jackie. All right. So to your point about how we play these on this second retest, right? We failed again, and I think that was on the same day. So this it's almost a double mountain top, but it's not, because they're not at the same level. You're familiar with the mountain tops?
Yes, I have heard of them. Yes.
All right. So when we have a double mountain top, on the third top, we usually break that resistance. Right. So on this one, there was no double mountain top. And by the way, what am I talking about? When I say double mountain top, what is that? I recommend everybody read or at least peruse the book called The Candlestick Bible. That's where you learn all this stuff. There are some some formations that everybody needs to know, you should know. So that's where you find all those formations. I'm talking about the bull flags, the bear flags, the double mountain tops, or even the triple, the double top. There we go, Rochelle. Okay, and then on this third one, which was basically the next day, we are always remembering. If you plot on your chart, you would remember this particular gap has to be filled. So I usually will draw something like that, just to remind myself what's happening. And as I go in, it is no longer just a regular play. Now it is a gap play, right? Now it's a gap play. And in this particular instance, actually, I would even maybe just bring that up. And why would I do that? Because it's been partially filled. Partial filled this much. There's this wick coming all the way down. There's this wick going all the way to that particular level. That's when you actually make that gap play, because it's been partially filled. So who was that? That was Patience. So Patience, I would, as price approaches here, I would definitely do a gap play on that particular trade. So I wonder whether I answered your question, but it seems like I talked too much. Did I even answer your question?
You did. So essentially, the only play you would execute on this gap is purchasing a call in expectation of the gap filling up.
Yes.
You would not consider a put on rejection of the initial resistance.
No, I would not.
Okay.
Yeah.
Okay.
Yeah.
Got it. Thank you so much.
Sure. Yeah, it would be a different strategy. If I'm playing the gap, then my thesis would be that I'm filling the gap, and if we're going up, yes, you buy a call. Now, obviously, it would be a 0 DTE call. It wouldn't be like a 7-day, 30-day, 45-day. It would be 0 DTE.
Oh, okay. Could you expand on that? Because in the past, I think you've recommended 45 to 60-day DTE when purchasing options. So,
but this is a short-term play. This is a less than 5-minute play, right? So I don't expect that we're going to fill that gap and stay in there or go above it. I'm just playing it knowing that the gap is going to fill once it starts filling. So for that reason, I'm usually playing that $10. Look at that, $44.70 to $44.80. If I'm going at the money, how much money is that?
it's usually 0.5.
It's a delta 50, right?
Delta, yeah. So
and it's 10 points. So on one contract, you're expecting how much?
$500.
$500 American. You're correct. Yep. So if you're going 3 contracts, you're doing $1,500. On this kind of plays, I will do maybe 1 or 2 contracts. 0 DTE, and it should last maybe 15-20 minutes. It's an easy $500. Yeah. But that's only on SPX. Others don't have such a big gap. Let's look at Amazon. Amazon is also gappy. We have a new word today, by the way, gappy.
I've already created the NFT.
Yeah, you have. All right. How do I invest in that? I'm going along on that one. I'm going along on that. But yeah, so gaps. I play the gaps on SPX. I also like to play zone to zone on that, because SPX is not very friendly in terms of. Well, it is friendly, but it takes a long time. Let me show you what I'm talking about. To go from zone to zone, for instance, the next zone I'm waiting for is somewhere around the 41.59, give or take. Right? That's just my thinking. Don't go to town with that. But I think that SPX has got some room to fall before we start going up. That's just my thinking. It means also that a lot of stocks have got room to fall. So every time we think that we've turned around, something comes up, but we're just following the natural projection. Also notice that even on the daily, which is, we do have some gaps that you can consider. Now, let me tell you a secret, by the way, about this apparent gaps. These are not gaps because they've been filled. But my experience with SPX is that it likes to fill these empty spaces with a solid green or a solid red candle. So I would not be surprised if once we hit this 44, 80, what is that, 4,500 level, we're going to spend a little bit of time over here, right? Filling these in solidly with a solid candle. I would not be surprised. That's just my experience with SPX. We like to feel those. So continuing the conversation on offense and defense, let's see whether there are any questions in the chat, by the way. I don't see any questions. Brittany, do you see any questions out there?
Yes, actually. Elvira asked, how will you place a trade on a seller's gap?
On a seller's gap. So a seller's gap is where price gapped downwards. So to play that gap, you would have to buy a call or buy a call debit spread. That's how you would do a seller's gap. So does everybody know what a seller's gap is? Let's find a seller's gap.
You were just looking at one. SPX is a seller's gap.
That was a seller's gap, right?
Yeah.
So seller's gap is, this is an example of a seller's gap over here. This is an example of a buyer's gap. Let me paint it here for you guys. Try and pointer. That gap over there is a buyer's gap. Label it there for you. Buyer's gap. And this one over here is a seller's gap. All right, there we go. Buyer's gap, seller's gap. So hopefully that answers your question. So all of these are basics. These are things that I consider basics when you're talking about options trading. There's a whole lot more to understand even before you get to this point, and that's what that's what I teach mostly in my program. For those of you who are not familiar with options with Eddie, by the way, I do go from the very, very beginning. I don't just start somewhere in the middle. I will always, make sure that everybody has the fundamentals. We get up to speed. It's a very, very small group-based discussion, and it goes on for 8 weeks, and we cover all the way to the advanced strategies to where you're making a consistent weekly income. That's what we do. So,
Is there a chat for is there a link for that call?
Yep, the link. So you can always find the link on the Facebook page, Options with Eddie, but also you can go to optionswitheddie.com. In fact, I'm going to type in my website here. It's simply optionswitheddie.com. What is the DTE? What DTE means days to expiration. Is that what Audrey is asking? Yeah. So yep, optionswitheddie.com. That's the new thing in town. It's definitely worth it. I think we have a few people who have had tremendous and outstanding success. Been doing this for about a year or so now.
Someone else asked, how do you play defense against a losing call? That was Emily.
Okay, so that's a defense part of the discussion today. How do you play defense when you have a losing call or a losing put or a losing position? It could be anything, right? First and foremost, before you play defense, or why would you need to play defense? Well, obviously you're losing. That's why you play defense. But before you get to playing defense, the very, very first part of that whole game plan is you have a stop loss. Now, I am not going to blast you for not having a stop loss, because sometimes I trade without a stop loss. But there are some times when you just didn't have the stop loss, or you were so sure about the trade, or you were in a call or a credit situation where you receive premium, we're almost hitting the bell, things turn around, and all of a sudden that spread that you thought was going to expire out of the money is now approaching to be in the money. How do you play defense on that? So there's several ways. The number one way that I recommend to play defense is to get out of the trade. Right? To get out of the trade. That's the number one most effective way to play defense. Get out of the trade. Right? It means that you're going to close that position. It means that you're going to crystallize that loss. That's what that means. That's the brutal truth, that you're going to crystallize that loss and you're not going to be able to make any more money or recover from it. That's the main one. Why do I think that's the best one? It's because your position or that trade is no longer good. Right? That trade is no longer good. Say you were in a call, the price starts going down instead of going up, and you redraw the chart on a daily time frame and you recognize that, you know what, it's going down to the next support level. If that next support level is so far away, guess what? It means that you have to lose a lot of money before you start making any money. Right? What do we know about options? They have expiration dates. If you don't have enough time between the time that you think it's going to go down and then come back up, start making money, well, it's going to lose you more money. So the best way is to get out of that trade, and then you would rather get back into the call down at the bottom. That is for calls, right? Would you buy a put while you're still in the call? You can do that. Is that smart? No, right? Basically, you're saying that you do not agree that you're losing money over here and you're in self-denial. That is the biggest form of denial over there. Just get out of the trade. Buy the put if you want. You can do that. It's a good strategy. But then you'd be getting in the middle of a zone, by the way. Right? So you'd be violating your own rules for don't get in between a sell and a buy, or a support and the resistance. So that's why that would not be such a great idea. You always want to go for as good a trade as much of an A+ trade if you can. So get real. This is not a game, right? This is for real. Don't play with real money like that. Just get out, stop the bleeding, then get in at the correct place. That is how I play defense on a straight call or a straight put. But also let's talk about when you're in a credit spread situation. What do you do? How do you play that? The way I play that is you can roll. I haven't talked about rolling on this call before, maybe, but you can roll a trade also. Do I roll single calls and puts? No, there's no point. Just close the position, get in at the correct place. For credit spreads, however, there are certain instances where you can roll the position for a credit onto either the next expiration, or you can roll it vertically. This is a deeper subject, by the way, where you can change the strikes during the roll. So these are things that I talk about in defense in greater detail in my class. But is it always wise to roll? I don't think so. I've rolled a few times successfully and some not so successful. In general, I think rolling only delays the pain. Or if it is not delaying the pain, it is reducing. It is reducing the loss. My policy on losses is that you should never ever take max loss. Never ever take max loss. Let's say that one more time. Don't take max loss. How many ways can I say that? It means that if you see that you're in a losing position and you can get something out of it, even if you know that, when you know that it's just not going to work out, don't throw your hands up in the air and say, well, whatever, right? It's a bad trade. No, try and get something out of it, especially if it is a credit spread. The reason I emphasize on credit spread is because the max loss on a credit spread is just too huge. Imagine getting selling a spread for 85 cents. Your maximum profit on that is is 85, right? That's your max profit. Your max loss is 415. on a 5-point wide spread. So if you let your spread expire with max loss, you are giving up how many times? Like almost 4 or 5 times that potential profit. Don't do it. So for credit spread, if price is approaching your short leg, that's the one that you sell. If price is approaching your short leg, say you had 44.50, 44.55 spread, and price is now at 44.50, 44.40, that is when you start worrying. Let me say that one more time. And let me also demonstrate here, guys. Just putting here. Okay, I'm going to draw 2 lines here. One's going to be 44.50. And the other one's going to be 55. Right. Those are common numbers. So if you have a spread that is 50.55 and price is now at 44.40, that is when you start getting worried. Right? That's when you start getting worried, because when you're within 10-point striking distance, then the value of your spread is going to approach maximum value. Not a good thing for credit spreads. So that's the time you start playing defense. You don't wait for it to get to 44.50. If you wait for it to get to 44.50, the only way you can roll is roll for a debit, right? Roll for debit. And that's a deeper discussion here. You want to roll for credit if price action is aggressively moving towards your spread and you're about 10 points away from that spread, right? Price is 10 points away. That's when you start talking defense for your spread. Now, that's one way. The other way is you could just pray and hope, get on your knees and hope that price is going to go back down around, or it's now 3:55 p.m. and you don't think that price is going to breach 44.50. Then at that time you can just hope that price is not going to actually break into that spread. I should warn you that they've got vaccines for a lot of things. They don't have a vaccine for hope yet. They're working on it.
I have a question.
Yeah.
If you get into that situation, say for instance, you did a vertical credit spread, and does it matter which leg you get out first? Is it going to go against you? Do you need to get them out of both of them? How does that work?
Man, does it matter what leg you get out first? I love your question. You do not get out of any leg first.
Okay.
Let me say that one more time. Do not get out of any leg first. You treat the vertical as a vertical, right? You treat the vertical as if you close both of them. You do not close the short leg first or the long leg. Well, you wouldn't be able to close the long leg first anyway, right? Why wouldn't you be able to close the long leg or even the short leg live on SPX? Anybody have an idea why? Would you be able to close the short leg first as well? Would you be able to do that? The answer is no, you wouldn't. You might have to have $1 million in your account, then you would be able to do that. So that's a hint. But let's consider, if you close the short leg, it means that your remaining long leg would have to be able to support that position. Most people cannot support a 4,400 value on, say, 5 spreads. You'd maybe need margin requirement. The margin requirement on that would be somewhere in the tune of, let's do the math here in my head, 4,500 times, say, 10 spreads. About 45,000, give or take, 450,000, one of those. So if you don't have that, no, the broker's not going to let you do that. It's a bad idea. Don't close one leg first. Am I clear on that? I don't think I was clear enough. It's a bad idea.
Very clear.
Yeah, don't. Whoever said that, I don't know, find a wall, bang your head on the wall.
I'm just asking.
But I like your question, Marsha, because I've posted a link, or I've posted my thoughts on that, because I've had it before. Somebody said, close the short leg, let the long leg run, and People who say that also fool a lot about other things too. So
Maybe that's where I got it from. So I heard somebody say it, so I just wanted to clarify. So thank you.
yeah, don't do it. Don't do it. That's bad. That's bad.
Morning, Eddie. This is Faye. How
Hey,
are you?
I'm well, Faye.
Listen, if we put in our stocks, like you told us a long time ago, that would protect us with SPX or any other trade.
Most things, yes. And that's why I said in the beginning of the call that when you're playing defense, assuming that you did not have a stop, this is what you would do. So you're right in saying that when you have a stop, that ought to be your first defensive mechanism, right?
Right.
So
And as far as that getting out one leg and all of that, you see that on YouTube a lot. I
yeah.
never believed it, but yeah.
Yep. You're right. Don't believe it. Don't get out with one leg. Tell you what, somebody play with real money and get out with one. Get out of the short leg and let us know what the experience is.
I tested in the Sims and it was bad.
Yeah. In the sim will let you do anything, right? The sim paper trading will let you do anything. It will let you break the rules. It will make you $1 million in about 30 minutes, right? But if anybody tries to get out the short leg, I'll even make a special Saturday session just so that we can listen to you.
Thanks, Eddie.
Nice. So yeah, thanks for that, Faye. How you doing, by the way? You doing all right?
I'm good. I'm good.
Awesome.
Yep.
All right. So let's see what else. So defense, yeah, for defense, there's not much. You put a stop loss. That's number one. You become a better trader, by the way, when you quickly realize that a particular situation is not working right. Right? When you realize and you accept that a trade is not going well, be quick to pull out to get out of that trade. I almost said relationship, but I think it's just it's about the same. Be quick to get out of that. How do I speed up? Is that what that means? I've got a little icon over here. I'm not sure what it means. Okay, so yeah, don't wait too long. Just get out. Just get out. Move on. Start the healing. All right. I'm gonna open it up for more questions. Anything, any way, any questions you have. If you want to know how to contact me, that's cool.
I have a question.
Yes, ma'am.
You said earlier that we should diversify our watch list so that we can always have something coming into one of our zones. How do we do that? And then I heard you talk a little bit about using bar chart to help with that. And so I don't know if you have time to kind of show us how will we do that? How do we find stocks that are in zones already?
Okay. So as far as using bar chart, I do have a video that is out there that you can watch, right? That's on my public YouTube about how to use bar chart. But then in terms of diversifying, what's a good watch list, and what does that constitute? A good watch list is one that is representing several sectors of the economy. There's about 11 of them, give or take. There could be more, I think. But you don't want everything in tech or everything in health or medical or everything in energy, oil, all that kind of good stuff. You want to diversify because not everything is in season at the same time, right? You get that concept of seasonality, right? So we know that in the beginning of the year, January through March, that's not a great time for tech. We saw tech stocks go down. We're about to see them starting to come up. So if you have a tech heavy watch list, guess what? You're going to be seeing red all the time. People are going to be saying they're making money, and you, meanwhile, you're going to be in your tiny office, you're looking at your screen and your eyes are just bloody red because there's no other color that they're reflecting, right? But if you have a well diversified stock, watch list, then you know that you can get into some really good opportunities for the stocks that are in season. Right now, what's in season? I think energy is in season, right? Tech is coming back in season now. We're going to start seeing some rising, but we have to have a some sort of retraction before we see that upside. And by the way, we've been talking about, or they have been talking about, recession for quite a while now. It's kind of like they're wooing recession. People want recession. Not everyday people. I'm talking about the institutions and the banks, all those big buyers. They want prices to come down. I'm still trying to understand what that means. Why recession? What does it mean? What will I see on a stock chart to know that, wow, we're in a recession? Look at that. Recession right there in front of us. What is that thing that you're going to see on your stock chart that is going to tell you that we're in a recession? Does it mean that it's the S&P going down to 4,100? Does it mean that it is what does it mean? Is it 43? Is it 100? Is it 4,100? There's different, depending on who you're listening to. Some number in between here is what they're talking about. I don't know, so I'm still to understand. But the question is, what do I do in the meantime? So I'll answer that in a question in a second. So to diversify your watch list, you need something good on your watch list. You need 5 ATR minimum, right? You understand ATR, the concept of ATR, Marsha?
Yes.
All right. So that's what I consider as the minimum or a good stock. It doesn't mean that I will discount something that moves $4 or $3. I just like something that moves a lot, because in my trading plan I have got quick entries and quick exits, and I don't want to be waiting all week. I want something that I can get in today, get out today, or get in today, get out tomorrow, the day after, not next week. Even though I buy 45 days, I want my plan to be executed or to go from start to finish in a fairly short amount of time. So, yeah, I want my bread yesterday, right?
How do you find those, like understand the sectors and the seasonality? Is it a book that you can read to find out which, like you said, January through March, not good for tech, so on and so forth? How do
I know that?
Yeah, how do you find that information out? Like which sectors are good for which?
I actually do not know a good way to find out, but if I have something on my watch list, let's say this is Amazon. I can probably look at the seasonality chart on that. There's two ways that I know. One way is to go into my settings here, go into appearance, change the chart mode from standard to seasonality, hit apply, go OK. Now I can see for this particular stock that is Amazon, I can see that this is the real one. This is the real chart. We're going down. But what do I think, or what does the seasonality tell us? It tells us that we are going to start trending upwards, then sideways, but somewhere around June, that is when we start heading upwards, right?
I see.
That's a seasonality chart on Amazon. You can look at a seasonality chart on your favorite one. Tesla, I don't know. Tesla is a different kind of breed. Apple is just continues going up, but I trade Amazon quite a bit, so I'm always interested in that seasonality chart. That's one way. The other way is to go to, let me first change my chart back to standard, apply and OK, is by going to stockcharts.com. See whether I can go to stockcharts.com. All right, let's see. I'm just going to bring that over here. Can you see that? Can see my browser?
Yeah.
Yep. Okay, and I'm just going to type in the symbol here, Amazon, AMZN. And once I get there, I'm going to scroll all the way down and push or tap on seasonality. And this kind of tells me that over the last, for as long as their data goes, usually it's about 20 years, what is the likelihood of this stock performing well? What month are we? We're in April. So April, we have an 80% chance of, if we get into a call, of that call expiring in the money or well above the current price, 80% chance. Next month, we're going down. In June, it looks like there's a 100% chance of that upside, which means that if you're going to buy Amazon, don't buy it now, or if you're going to buy it now, you should be buying puts, not calls. And then what are you going to be doing next month? You're going to be buying calls, because you have a 100% chance, according to this almanac, that it performs very well in June and then starts paring down before we get into the Christmas season here. But this is a good play over here from 25 to 100%. I think that's amazing, right? That's amazing. So if you're going to play Amazon right now, you should be buying puts. That also lends value or weight to the SPX, because Amazon is one of the stocks that weighs very heavily on the S&P 500. So if we think that it's going to go down in May, guess what? The S&P is not going to be going up. It's going to be moving with Amazon. Yep. So you can throw in any symbol over here. The link is stockcharts.com. This is the free one, the free version. You don't need to pay for anything. Just and if you want more insights, you can also look for some, I think it's called seasonality.com, or anyway, just Google seasonality, and that will give you more in-depth. You obviously you have to pay for that data and more insights. But yeah, plug in your stock symbol here, look at the seasonality, and see how it works. Sounds good?
Thank you very much.
Yeah, you're welcome.
Eddie, on diversifying your watch list, is there a risk, particularly for those of us who are new traders, of kind of becoming overwhelmed with the number of stocks to follow and keep on top of? The larger and the more diversified that list becomes. Do you have any concerns about placing trades purely based on charting without understanding a bit more about the current state of the company and doing a bit more background research before executing a trade?
Got it. So there's plenty of parts to your question there. First and foremost is a question of risk of the number of things on your watch list. So I don't have a very big watch list, by the way. I have random things. These are not even things that I trade, so I don't even keep them up. But when you build your watch list, you're likely going to have about 10 to 15. I think that's a healthy amount of stock symbols on your watch list. Does that mean that you're going to trade 10 or 15? No. In fact, I recommend that you only trade 3 to 4 times a week. Right? 3 to 4 times a week. That means that you're going to be doing a lot of waiting. Right? A lot of waiting. Patience is very, very key to this. So why is that? It's because you're just waiting for things to come into your zone so that you can go long or go short. What I recommend also is, even if you have a whatever size watch list, get to know about 3 or 4 stocks very, very well. Right? You need to know just a few stocks very well, so that when you see that your stock is at a particular price point. I've had some people trade Nvidia. That's all they do. They don't trade anything else. And when they heard that Nvidia had touched 200 and something, they were like, I'm a buyer. And I said, really? Yeah. And by the way, this particular person who I was talking with doesn't know how to read charts very well. But when I looked at the chart, I was like, he's spot on. It looks like we're in a buy zone right now for Nvidia. So if you're buying on the longer term, we've got a few gaps to fill that look very appealing. Right? And then the second part of your question was something about fundamental analysis. How do we trade when we're not very familiar with the fundamentals of a company? There are 2 types of traders. There's the technical analysis traders that that you and I probably are. We look at the charts, we look at the data before us to help us guide what we're going to do or what the chart we think is going to do. And then there's fundamentals, people who look and see, who's the CEO, when's the last time we had a dividend, what's happening in the company, what's the competition doing that, are they being innovative? And that helps guide them whether they want to buy that company. I think that's a lot of work, but it is valuable. Some people do that. In fact, a lot of institutions spend a whole lot of time. They've got departments whose job is to do nothing else but to analyze the fundamentals of companies. So it is valid. But I'm not that kind of trader. If I were to trade on fundamentals, then I might be more likely to trade ETFs. Anybody familiar with ETFs?
Yeah.
Yeah, I might be more likely to trade ETFs than even mutual funds inside my retirement account or long-term account. For one, if we're talking about fees and stuff like that, then ETFs have lower fees. But yeah, patience. Are we in sync on that?
Yes, we're in sync regarding having a watch list of 10 to 15, and then within that, kind of focusing on 3 or 4 that you're most familiar with, and kind of focusing your trades on those as much as you can. On the fundamental analysis, I wasn't proposing that as the primary trading strategy. There's something in me that will feel a little uncomfortable if I'm mostly trading 3 or 4 stocks out of my 15 on the watch list that I know very well. And then let's say one of those I'm less familiar with, it's not, the top 4. And I traded purely based on the chart without really knowing why the price has gone where it is and what's happening within that company to support that price movement at some level. And so I think it was just kind of trying to find that balance between knowing something about what's driving price movement within the company, but not going too far into fundamental analysis.
You bet. I'm with you on that. I'll give you a quick example here. So some people actually do trade the symbol QQQ, right?
Mm-hmm.
For instance, do you know what's inside the QQQ?
I'm not sure. I think it's NASDAQ related, but it's not something I'm super familiar with trading.
Right. How about SPX? You know what is inside it?
Yeah, S&P 500. Yes.
Do you care about what's inside it?
I assume it's the largest 500 stocks in the US.
Yeah. I mean, do you care? One way or another? No, not really. Right?
I don't really care what the components of the 500 are. No, not really.
Okay, right. So why would you care about the fundamentals of a company?
I think if I think about a company like Peloton, for example.
Yeah.
Or Robinhood, for example.
Oh, which one?
Where they had really Robinhood or Peloton, which are stocks that I don't trade, but just to illustrate the point that we're discussing, where, in 2020s, and now prices are falling into various buy zones, but I wouldn't buy those companies given what I know about what's happening in those companies and the industries and why price is decreasing. I wouldn't see those as a buy opportunity despite them being in buy zones.
Got it. I think you answered the question there. Knowing what you know, I think that's what is helping you out there, because taking a stock like Piton here, for instance, we know that they've had negative press. They're not necessarily a bad company, but they've had negative press. They've had gaps that they are having trouble filling, and so the fundamentals are playing out in the chart itself. But somebody who's looking at the chart would, even without knowing those fundamentals, that the chairman is having problem, they're switching CEOs and all that kind of good stuff. Even without knowing that, the chart is telling the story. The chart does not lie. It is reflecting exactly what's happening. So I think that technical analysis for your kind of trading and my kind of trading, I think, is the better way to go. But I would not ignore the fundamental analysis whatsoever. If you told me that, something about a company that is significant, I have to pay attention. For instance, why do we avoid stocks that are of Chinese origin? Because the US government is constantly blacklisting them. Do I just ignore that? No, I can't ignore that, because I don't want to be left with a stock that has no value at the end of the day, right? If you tell me to buy a stock that of a company that is about to go bankrupt, would I do that? It would be monstrous if you were to tell me go buy Hertz, right? You remember Hertz car hire company when they were going bankrupt? Their stock dropped to valueless. You ever heard of that?
Yep.
Right? One day it's $12, the next day it's worth $0. That's called max loss. I don't even, is that max loss? Yeah, it's max loss. Yeah. So anyway, fundamentals, yep. Use the news for what it's worth. That's the way I would answer that question. So,
Thank you.
sure. And Yvonne wants to know whether I have time to do this. Okay. Yep. Do I? Should I? Maybe not. Okay. What other questions do we have? We have 12:14 p.m. Eastern Time.
I have a quick
Hey, Eddie.
question. Oh, go ahead.
Eddie, I have a question. On gaps, would you put a stop on gaps? And if so, how?
I would follow the same rules regarding my risk management. So you might have heard me speak and say that I will usually risk somewhere around $250. So when I'm trading with gaps, I follow the same rules of what is the likelihood, what is the profitability of that trade, and based on that profitability, what is a good risk? So short answer is yes, I would definitely put a stop on it, because I don't know whether that gut is going to fail. I don't know whether it's going to start moving in that direction and turn around. But regardless, it's a trade. You have to have risk management. I have to put a stop.
So on a seller's gap, would you put the stop, since you would buy a call, would you put the stop at the bottom?
On a seller's gap, you're buying a put. Is that right? Sorry, you're buying a call. Yeah, seller's gap, price gap down. So you're buying a call to play up. And okay, what's the question?
Where would you put the stop, basically, on a seller's gap?
That would depend on the premium itself.
Okay.
Yes. So I think you're thinking in terms of shares.
I am,
Yeah.
yes.
And that's a whole different process where you have the share price as your stop, and you're thinking below the gap or above the gap. But when it comes to options, you're no longer trading in the shares, you're trading in the contract itself. So let's go with you know what, let me bring up another Thinkorswim instance here. And while that's loading, I'm going into my live, by the way. So
Hey, Eddie, let me interrupt real quick.
yes.
I've been waiting to learn how to use more than one instance of the Thinkorswim desktop like you just did.
Yeah.
Looked like you went from a command window.
I did. I wrote a few. I'm a programmer. I'm a IT professional, so I have the advantage of being able to manipulate these behind the scenes.
I know a little bit about it too, so
Say again.
I'm familiar with some of the things you're talking about.
Okay, so you're familiar with the command line and you want to know how to do that?
Yes.
Okay, I'll show it to you.
Thank you.
There we go. Which think.sh.
Oh, okay. You've got it set up to prompt you.
Yep.
Okay.
There we go. It's as simple as that.
You're using a shell script.
Yep. So open -n applications, Thinkorswim. If you're on Mac, that is. If you're on Windows, it's a different story.
No, I'm on Mac.
Okay. So this is the one line that you need.
Open in applications. Okay, got that much.
Okay.
It makes sense. It's the path I know.
Yep.
Okay, thank you.
You got it?
Yes, sir. Thank
All
you
right.
so much. That was worth the price of admission.
Oh, this webinar here is free, by the way. So
I know that.
yeah, it is free. But some people do send me tips every so often.
Thank you for that.
Appreciate it. So I'm in my live. Why did I go into live here? Reason I went into live is because I wanted to show you a cool trick inside the live where you can go to a watch list called gap up and gap down. Yep, so it's under the public F through N because G falls between F through N. I finally discovered why they had this. You know? That's interesting. So why do they have that gap down? All right, so the gap down watch list. This is a list of all the stuff that gapped down over, I guess, yesterday, right? Last trading day. And you can customize this gap down list. You notice that the ATR on this one is giving you everything from 0.5 to 8 to, you know, some weird ones, right? So you can customize that. I should probably have a whole class about that. How to use this and customize that list such that when you get your gap down list, it's not giving you all these weird stocks that just move like a couple pennies a day. You want things that are moving at least $1, $2, maybe even 8. Because I saw one here with no. Anyway, for demonstration, this is a gap down. So your question, and I forgot who had asked, how do you set that stop loss? You would
Elvira.
Okay, Elvira, thanks. So I would simply set my stop loss to based on how much I'm spending usually, and also based on how much I'm expecting to make profit. So I'll give you a general rule, right? General rule that is well known in the industry is we try to go for a 3-to-1 risk reward ratio. 3-to-1 means that if you're making $300, then it would be reasonable to risk 100. Is that a fair statement there, Elvira?
Yes.
Okay. So if you're thinking that your trade is going to make you $900, how much would you risk if you were to go with a 3-to-1?
$300.
About $300 is about right. That's still 300. And if 300 is going to destabilize your account, should you still go for that 3-to-1?
No.
Okay, so that would be an answer that you would, evaluate based on your own personal situation, and it's valid, right? It's whatever is correct for me is not correct for you, and vice versa. Let's play one more example here. You're playing, say, Amazon, and you think that on this particular trade you're going to, potentially get $3,000. Right? How much risk would you put on that?
How much I would put $350.
$350?
Yes,
Okay.
that's what I use.
1,000.
Okay. All right. So you can see it's relative, right? You're potentially going to get $3,000 and you want to risk 350. What's the likelihood you're going to be stopped out?
Oh, fast. Yeah.
Yeah. Okay. So you can see what are the things that you're asking yourself. So personally, if I was to target a $2,000 profit, then I might be comfortable with a $500 risk.
Okay.
Right? If the payout is 3,000, I would still be comfortable with a $500 risk. I would not increase it. Why? Because the risk shouldn't necessarily be relative all the way. It's not true. The more the profit, but for a small profit target of say $300, $500, it's more reasonable to go with a 3-to-1. But as that payout becomes more and more, then you have to adjust your risk accordingly. There's no point in saying that, you know what, this trade could actually get me $5,000, and so I'm comfortable risking, $1,000, right?
Okay.
That's huge, because now if you lose 1,000, tell me how happy you are when you lost $1,000 because your thesis didn't go well. I think you would feel more devastated with that $1,000 loss than if it were just the 3 to 500. So when it comes to risk management, I say that yes, go with the 3 to 1 at least. But as those amounts, the profit target gets bigger and bigger, you need to, bring down your risk level and decide what is that maximum. For me, $250 has been, sort of that point where I realized that, this is not going well. But on a $3,000 payout, I'll put a $500 stop loss. I'm comfortable with that, right?
Okay.
Because on a stock that moves that much, you know that $100 or even $200, say SPX, if you put a $100 stop loss, they'll hunt you down. They'll come and take that in a heartbeat, like 10 seconds flat. They'll take it. That's my answer to you.
Okay. Thank you.
A question.
Eddie,
Oh, go ahead.
Eddie, on your $250 stop loss, is that regardless of how many contracts you buy for you?
So I'm a one contract kind of guy.
Okay.
If I have more contracts, I might reduce that 250 to, or I might spread it out to maybe $500. Let's say I am into 3 contracts, which is a number that I have come to find is very, very comfortable for me as a maximum number of contracts when I'm doing straight calls or straight puts. So in that particular instance, I might go with $500.
Okay. Thank you.
Yeah. But on par trade, I try not to lose too much. So
I have a question. As I'm finding a lot of times that my trades are turning around, like I'll be in profit and then I'm like, okay, well, I'm gonna go ahead.
Yeah.
I know what my estimated target should be. I've calculated everything. I've done my odd enhancers. Everything looks great. Everything looks good. And I'll get in the trade and it'll start going up. It's like it's starting to reach my target.
Yeah.
I've estimated how much I should profit should be, and then it'll turn around.
Yep.
So I don't know, like, do you look at your estimated profit and say, well, if it gets to maybe 50% of that, then I'm out? Or what's your trading plan for that? Because I seem to always struggle with that one.
You need to be in my class, Marsha.
Okay, I'm gonna take class.
Because I have a formula that works
Right,
consistently
class.
to solve that problem. But I think I know what part of the problem here is. Part of the problem here is that you're getting in between zones. You're not setting.
No,
Yeah?
I'm at the zone.
You're at the zone. You're getting at the zone, and you're getting stopped out.
I'm totally at the zone. Then I check
Yeah.
my 15-minute chart to see if it's kind of headed out.
Right.
And then I get in, and then it turns around. I mean, within a few days, a couple
Well,
days.
then there must be something else going on.
Okay, I need to take your class.
But that is a very, very common and frequently asked question about how do you not get stopped out? How do you identify what is a perfect trade? Well, maybe not a perfect trade, but what's an A+ trade, right? So we have something that we discuss and we formulate. We go through several steps that guide us into a higher probability of success. We don't know what's going to happen. We are not predicting what's going to happen, but we can build a trade in a way that we have a higher probability of success. And we also find that if you play it like that, you become more consistent and you trade less, but you make more. The idea is to trade less, make more, be more consistent, rather than trying to chase this dollar every day. That becomes very, very difficult. You put yourself under immense pressure. So I don't want to give you all my secrets out there, Awesome. So let's see. We have 12 and a half, 12:50. Let's talk about what's going on these days. Where should you be? What's happening? And then we're going to close. How about that? Right. So I think that with the current market, somebody help Alvaro out there with my link. With the current market of things going down, I'm particularly looking at the S&P 500 because that is what is driving, or it's representative of the economy. What should we be doing? Almost everything looks like this. When I look at the chart for S&P 500, this is what stuff looks like. It's either in the middle, or it's going down to a zone, or it's just out there. What should you be doing? And people are asking, just like Marsha asked. I seem to get into a trade. 2 minutes later, I get stopped out. It was a great trade. She even did her 15-minute confirmations and all that, but still it's not working out. What should you be doing? My thoughts on this, and this is not professional advice, this is not financial advice, I should say. You can lose your money, you can lose a whole lot. What I would be trading right now is selling, right? So there's two ways. You can be selling, and the question is, which side should you be selling? In my opinion, you should be selling the top side, or you should be selling credit, call credit spreads. That's one way. That's the only way to sell, by the way, inside a spread. Don't sell naked. Is anybody confused about what selling naked or selling inside a spread is? Hopefully not. And if you are, let me know and I will help you out. So we want to be selling inside a spread. That's one way to do it. That's a conservative way. There's a lot of risk, so you do need to be very, very familiar with that kind of selling because of the astronomical risk that comes with credit spreads. They're good, but the other way is to do puts. So right now you can't go wrong. Shouldn't say that. Right now, your best bet is on puts because everything seems to be going down. Even when it goes temporarily up, it seems to be in a downtrend. That seems to be supporting where most analysts are thinking that the price is going to go. At least for the near term, maybe the next, I don't know. I can't even put a time frame on it. But I think puts right now are very, very strong. If you look on the longer horizon, then call debit spreads are also the way to go, meaning that you can get your best price right now on the call debit spread as prices are going down. But you have to buy time because by the time they turn around, then they will be so expensive. If you have attended any of my classes and you know how to work on a call debit spread, you know that the best time to buy it is when it's going down for call debit spread, and then you wait, you've got the time, then there's that strategy that you can use. So those are the three things that I'd be doing right about now. Selling premium for call credit spreads because the upside has already been defined, we're going down. And then buying puts, which is the simplest way to take advantage of prices falling. And then a more complicated way would be to buy the call debit spreads, right? Call debit spread, by the way, is a directional strategy that says that actually this I should say put debit spreads because to take advantage of falling prices, but also call debit spreads on the longer horizon. It might be confusing. I'm telling you to buy calls when the prices are falling. It's because I think there's a bottom, right? We don't know what that bottom is, but once you have learned your chart and you figured out what could be a possible or likely bottom, then you could invest in a call debit spread knowing that it's going to bounce at the bottom, go back up, fulfill your dream, but you have to get in at a very, very low price. So a call debit spread is a strategy that has got a defined profit, defined loss. It is much safer, much smaller than any other kind of spread. So more on that at Options with Eddie. So hey, thanks for posting that out there. Very cool. That is Saturdays with Eddie. Let's see, 2 more questions and we close. How about that? Who's got the honor? read through the chat here.
I have a question about your class. So how is it structured? Is it structured by topic, or is it just sort of open-ended like it is today? How is it structured?
Great question. It is not
What-
open-ended. So we do have a curriculum that we follow. It is 8 weeks. And it is a small group size, so maximum of 10 students per class. Once it is full, that's it. I either make another class or people have to wait. So there are topics that we go through. We make sure that you get all the fundamentals in. So we level set the room. Then we go topic by topic. It takes me about 8 weeks to do that. And we meet once a week. There's always going to be homework, assignments, things to do. In addition to that, we also meet a few times during that 8-week course, live trading. We trade mostly in the sim in the first couple of weeks, and then in the next few weeks, we start balancing by trading one live and everything else in sim. The idea is to get that fear off, give you real life experience, give you that give you that experience of actually trading the concepts that you're learning. And these are concepts that you might have heard anywhere, somewhere else, but they're not just general. There's concepts that you will only find with me. They're not overly complicated, but they're actionable and they will help you make money. That is the bottom line. This is not an expensive hobby, right? Most of the people, or actually 100% of the people who are joining my class actually have a need to make the money and either substitute their day jobs. They want to quit their day jobs, or they want to make this hustle the main hustle, right? So there's that need. We're fulfilling that need. It is results based. We're not just giving you academic knowledge. Anybody can do that. You can go to YouTube University. You can go to, I don't know. There's so many places you can get it. We want actionable things, and that's the difference. And you get access to me. So cool. Faye, yeah, that's approximately right. Every couple of weeks is when is what I do. Faye is asking when the next Saturdays with Eddie is. So. Does that answer your question there, Marsha?
Yeah, so it's at varying levels, beginners, intermediates, and advanced.
Yeah, actually, I do have several classes in progress right now, and I put students based on their level of experience or where their journey is. I won't put you in a beginner class where we're learning how to spell stock, right? If you've been trading a while, that would be a really boring. It would not be a good use of your money. You need, so if you've been trading a while, then you need the appropriate class, and we have that for you. So yeah. Cool. Great question. All right, guys. It's the Easter weekend. We're waiting for Sunday for him to rise. So I am going to wish you a very, very, very happy Easter weekend. And if there are no other questions, we're going to end it. Thank you to my co-host there, Brittany, for helping me keep everybody there in check, all the questions, sending me those messages. Thank you very much.
Thank
You're
you.
welcome.
Happy Resurrection Sunday.
Yes.
Have a blessed weekend, everybody.
Thank you.
Thanks, Eddie.
Thanks,
Thank
Annie.
you. Thank you.
Thank you.
Thank you.
Thank you. All right. Bye-bye.